We are going to bet that nearly all of you have juggled with how to think about fixed income allocations in the current environment. Let me tell you the basics of how we think about it. Welcome to this edition of the LPL Street View. The low interest rate environment since the financial crisis has undoubtedly been tough on those investors seeking steady, risk-averse income from fixed income portfolios. Prevailing conditions have caused investors to increasingly seek exposures in what we call non-core fixed income sectors, such as high yield, emerging market debt, bank loans, and non-agency mortgage debt. While returns in many of these segments can be attractive, they do carry higher degrees of risk and higher correlations with the equity market. In fact, U.S. high yield, emerging market debt, and leveraged loans over the last 12 years have had much higher correlations with equities than the Bloomberg Barclays U.S. Aggregate Bond Index. The U.S. Aggregate Bond Index, by the way, is a benchmark for what we call core bond exposure. Importantly, core bond segments can act as portfolio ballast in times of high market volatility. The message here, just because they call it a bond doesn't mean it always acts like a bond. This is why the difference between core and non-core bonds is a very important consideration. So how do we juggle the desire for better returns in fixed income, given the environment of low yields and relatively low returns for core bonds? Well, we believe it comes down to properly segmenting your bond exposures into core bond and non-core bond, and assigning a max amount of the non-core bond exposure you are allowed. When we allocate assets at LPL Research, our tactical limit on non-core bond exposure is 25% of our total bond portfolio in most cases. Our fixed income strategist, Lawrence Gillum, holds us to this number to ensure we maintain a healthy balance between potential return and risk. Your non-core exposure limit may vary from our number depending on the objective of your portfolio. The key here is to mentally compartmentalize your non-core bond exposure and assign a budget which you cannot exceed, much like setting a household budget. Ideally, this budget may allow you to realize your income and return needs while maintaining enough core bond exposure to help keep your total risk profile very well contained. In addition, we believe this core non-core bond allocation strategy may offer investors fewer correlation surprises in a volatile market. This may be especially true today when bond valuations are relatively high and much of the low-hanging fruit in non-core bonds has already been picked. So keep your non-core bond exposure tightly managed, and remember, when it comes to running your fixed income allocation, boring can often be a good thing. Thank you for joining me today, and as always, allocate wisely.